Welcome. You're watching a very, very special edition of the Mutual Fund Show. I'm Tamanna Inamdar. Now, why am I saying this is a very special edition? Because we have Radhika Gupta, MD and CEO of Edelweiss AMC, who is joining us today. She's talking about a whole host of things with us. We'll also talk about the Edelweiss Business Cycle Fund, what makes it unique. Also about your conference, which starts off from today, Radhika. And this is a great time to talk about what's happening in the mutual fund industry. So first off, thank you so much for joining us on this special edition. Always a pleasure to talk with you.
Thank you. Thank you for having me.
Yeah, all right. Let's start with the big picture over here, the top trends in the mutual fund industry. Now, if we were sort of to just check in and see where we are, we now know that the domestic retail investor is one of the most important forces, if not the most important force in the Indian markets. SIPs have become a way of life. But in light of the recent uncertainty in the markets and some concerns about what's happening with small cap funds, do you think that there is a need for reassurance?
So I think structurally, mutual funds are becoming an increasing part of Indians' asset allocation. And I don't think that trend will change, the long-term trend, because it's a trend that you saw in China, it's a trend that you saw in US. I think financialization is an important trend. And in India, people have realized that finally the mutual fund offers accessibility, options, convenience at a very low cost, and the ability to take your money back efficiently and quickly, which not too many asset classes do. And with markets being the way they are, the returns that mutual funds have on the equity side are given. So I think that's structural. The retail investor is actually the most important investor, because if you look at if you look at domestic institutional investors, plus retail investors outside mutual funds, they're now larger than foreign investors in terms of their contribution to equity markets. And that's a rising number while the FII number has been falling. So I think all of that trend is structural and it's going to continue. In fact, we see that trend rising, particularly outside the top 30 cities in India. So it's not just a big city phenomena. I think as far as short term, the concern always is, and investors go through aging, is that a set of new investors have come into the market after COVID, 2021, 22, and they haven't seen a correction. If you look at the last 1 year numbers on large caps, mid caps, and especially small caps, they look almost unbelievable. In fact, I get very nervous when I see headlines saying mutual funds are offering 70% returns in the last 1 year. They're not offering; those are past returns, and there's no guarantee they'll be repeated in the future. So I think setting the right expectations, calibrating portfolios in terms of how much small cap exposure people are taking, these are important things.
So, not to speak about specifics, because you have a different story every day, and social media has, I would say, Radhika, really given voice to the investor, which is great, but also runs the risk of conflagrating individual issues into the idea that there is a bigger systemic problem somewhere. And you have, I would say, sometimes irresponsible voices pushing that agenda, right? That is there going to be a bubble? Is there something happening? Are platforms working correctly? Is there an issue if there is a SEBI inquiry, etc.? What is your message on that? Are we now able to say that we are at a cycle of maturity in a very well-regulated market, that no one should have these questions?
I think the answer is nuanced. I agree there is a lot of clickbait content on social media, and it's very sensational. And X has one issue, and it's very easy to paint the industry. It's very easy to say, I have seen videos that are absolutely ludicrous saying mutual funds are the scam. And this is just clickbait stuff, right? So many years of private sector mutual funds, and finally, if you call for your money on T+2, you get your money on T+2. It's actually easier to redeem from a mutual fund perhaps than it is to shut a bank account, close a fixed deposit, certainly sell a property, claim an insurance policy. So I think the industry has proved that. And, within all the good that we have done, will there be places and names and incidences where there will be periodic issues? Yes, there have been. Uh, there may continue to be. But does the industry learn and get better each time? I do believe so. I think the worst thing that you can do is take a single incident, news report, activity, and paint the whole industry with that. That's extremely irresponsible and unfortunate. And I would just urge people not to do that. The only request I would have to people is, investors, everybody has the right to ask questions. Please ask more questions of your fund house. Please ask more questions of the industry, but ask factual color. It's always good to keep improving financial literacy and your level of know-how. But it's not good to make random allegations.
I mean, that's important. Not good to make random allegations, and have faith that if there is any misdeed, if there are any individual lapses, then you have a very strict kind of system that is looking into it.
You have a regulator who's, if I, sorry to interrupt,
Sure.
whose technological capabilities, whose surveillance capabilities, whose understanding of data, if I can say it, has improved meaningfully and continues to improve. So, and whenever this industry has had an issue, I mean, in 2018, if we had a crisis around fixed income, so many more regulations came to protect the investor around fixed income. So please use all the disclosures that funds give you that are meant to protect you. Know that action will be taken if it needs to be taken. And I repeat, don't paint the industry with a black mark.
Oh, and absolutely, you shouldn't paint the entire industry with a black mark. Now, let's come to the investment cycle, and what is exciting there. We are setting up for a big event. One of many, I would suppose, through the year, but the budget and the first full budget after a general election is truly a big event. We've just passed through one in terms of the general election and election day results, etc., and all the upheaval there. What would be your outlook ahead of the budget, where you have continuity in governance and expectation that there will be more of the same in terms of policy outlook?
I think continuity is the key word. I mean, regardless of this budget, in every budget, I look for continuity because I think, and I think this regime has done a good job in the last 10 years of continuity. I think you've laid out a vision for India Bharat in Amritkal, a focus on more capital expenditure, more long-term investment, kick-starting private investment in the economy. And I think at a time when GDP growth is in this shape, I would expect the budget to be execution towards this outcome, continued execution towards this outcome, which is what I think past budgets have been. I think budgets are always a balancing act between making different constituents happy. And the constituencies are middle class, the constituencies are bond market, the constituencies are equity markets. But I think that the core message is execution towards a long-term vision that was laid out a couple of years ago towards Amritkal, towards Atmanirbhar Bharat. I think a certain set of reforms, for instance, PLI, boosting manufacturing, these are priorities that have been talked about time and again. So more work towards those priorities. And to a certain extent, if new priorities have been picked up in the next 5 years of NDA government that were perhaps not such a big part of the last 10 years, for instance, employment and skilling of youth could be a particular one, then those. But I think continuity is the key. From a capital markets point of view, the best thing you can ask for is continuity in tax regime. There was a change in fixed income taxation last year. As a mutual fund industry participant, I always wish that is looked through again because it's really hurt the debt mutual fund industry. But on equity capital gains, I just hope for continuity and no change.
Ahead of this big event, and actually as we set up for the third term, we're also seeing the industry come out with a lot of products focused on this theme. So that brings me to the next point about thematic funds, whether it's a fund focused on PSUs or on defense or on EVs, because we keep having those conversations, right? So all of these themes focused on what the government intends to do over a long term. What is your take on this? Is it too risky? Is it really a good investment choice or a good investment direction rather than something which is interesting in a marketing sense? It sounds great, right? But is it really the best choice?
So I tell you where, how we think about it. I think investor risk appetite, as you're saying, has just gone up in general. And a lot of these thematic funds and thematic NFOs come out. And we did some interesting study. If you look at the long-term return of equity markets, it's about 15%. The long-term return of all these sectors is 15%. So in the long term, there's actually not that much sector deviation. But the reality is there are phases when manufacturing does well, there are phases when financial services does well, all of that is good. The problem, however, is two. One, sometimes these launches come out a little bit after the run up has happened. So, for instance, if you go back last year, the PSU, the 10-year return of PSU funds was something like 7 to 9%. Nobody cared about PSU as a category. It's been a great year for PSUs. That 10-year return suddenly looks double digits. Everyone's launching PSU funds. The other problem consumers have is the entry point is much easier. Exiting a thematic idea is very tricky because it's difficult to get the timing of that right. So, long-term structural themes like consumption, financial services are still, less cyclical. But some of these other themes, in my view, can be very cyclical. So it requires very sensible entry and exit. And, we at Edelweiss AMC are trying to find alternative solutions to solve the problem, some of which I'm hoping we'll talk about.
No, absolutely. We'll get to the Edelweiss Business Cycle Fund. But I just want to pick up on one comment you made, Radhika, about how risk appetite has gone up in general. And I think this is very interesting. It also bears out, I must tell you, sample size is not big, but this is a show where we take queries from our viewers, right? And the queries that we've been seeing over the last several weeks coming in are a lot about wanting higher return, taking higher risks, more focus on thematic funds, and moving away from the bread and butter of what your portfolio should look like. Now that's, what I'm seeing from a very small sample size. Curious to know what you were saying in terms of why you would say risk appetite has gone up.
Well, I think there's a couple of reasons. One, awareness has gone up. Second, the last 3-4 years of returns have been outstanding. So I always say risk appetite is actually tested in bear markets. But 3-4 years of outstanding returns and everybody feels everyone's making a lot of money. And so that's why risk appetite has gone up. People haven't seen a correction. Risk appetite has gone up in terms of sector funds. Risk appetite has gone up in terms of small cap allocations. You go tell someone you're going to earn 12 to 14% long-term returns in equity, and they look at you and say, you don't know what you're doing. So whether it's small caps, whether it's thematic funds, whether it's concentration, there is a general uptick in risk appetite. People want more. And I think as money managers, there's a bit of pressure on us to deliver more.
Just you said that risk appetite is actually tested in a down cycle, which a lot of investors and a lot of new investors have come into SIPs have not really seen that. They are going to panic when they come across that. Just your conversation to them, because an up and down cycle is inevitable, right? And there's going to be a time when people look at their portfolios and wonder if they made a mistake. So what would you tell them right now?
Well, actually, the SIP approach is of all the approaches you can take, the SIP approach is the best approach, right? If I was recommending investments for someone today, I don't have a problem with small cap investments. I would say STP or SIP your way through, because at least for the SIP investor, in downturns, they do cost averaging. So if you see SIP returns, as long as you are a little bit long-term in nature, over a 10-year return, over a 10-year period, even if markets deliver single-digit returns, your SIP returns are actually okay. So I think the message to investors is don't forget asset allocation, don't over-allocate to small caps. I've seen portfolios that are 50-60% small caps. Try and find solutions in the large and mid-cap space also, because that's the core of your portfolio. If you're conservative, make sure you have that debt allocation. And if you're investing, keep your time horizon long.
Now, Radhika, I also wanted to talk to you about the business cycle fund from Edelweiss. Can you tell us how this is different, for example, from other thematic funds that we just talked about?
So I think it's trying to solve a problem that we talked about with thematic funds, which is that they are cyclical in nature and entry and exit is difficult. And we thought that, can we solve two problems? Can we create a single fund where a consumer can invest and the fund takes very deep, aggressive calls in entering and exiting sectors, which is essentially what a business cycles category fund can do. So, the fund has the flexibility to hold 35% in pharma if it so be fit, and hold 0% in private sector banks, which is something a traditional diversified fund will not do. Because if you look at the sectoral allocations of most diversified funds, they're very similar to the benchmark. So benchmark has 30% financial services, most diversified funds will have 30% financial services. Can we build an all-in-one solution that does the sector rotation for you, so that you don't have to go look for a new thematic fund every 4 months or 6 months or 1 year? And we also thought, can we build a solution that provides alpha in the large and mid cap space? Because consumers already have so much exposure in the small cap space today. So can we provide a solution that's more aggressive in the large and mid cap space? These were the two problems that we were trying to solve with Edelweiss business cycle funds. And the difference in approach is this: if you look at most funds and their approach to business cycles, it tends to be predictive. You're trying to figure out, are you in recessionary conditions or inflationary conditions? Then what sector does well? Then what stock does well? And we've increasingly found, as you guys will know, that predictions are difficult. Whether it's difficult to predict the election, it's difficult to predict the market's outcome of an election. Instead of that, can we use a more factor-based investing approach that uses data to do business cycle-based investing rather than a predictive approach?
Yeah. So in this factor-based approach, right now, for example, I mean, you've explained the broad theme in detail, but if I were to put a for example element to it, right now, would you be looking at a business cycle up move based on, say, the consumer theme? Assuming, for example, that this government will look at increasing consumption patterns. I mean, I'm just throwing things out there. I just want to get an idea of what are the business cycles which are looking like they're on the up move right now to you.
So I'll tell you the input and then the output, because the input is important. We don't do things top down. We look at things bottom up. So we look stock by stock, and sectors and cycles are an output. So the intent is to look at companies that have either value or quality in them and are showing price movement and are showing a turn in the cycle. Now, if you look at the current portfolio, capital goods and manufacturing emerges as one theme that has the factors aligning, is showing reasonable momentum. If you look at the current portfolio, financials is another category that is showing reasonable momentum, but it's not what you would traditionally associate with financials, which is a lot of private sector banks. It's the non-banking side of financials. So those are the current themes. The idea is we don't try to predict the future. Now, tomorrow, if there is action in consumer durables or some of the more rural-centric stocks, and we start seeing price movement and we start seeing those factor aligned, then they'll make their way into the portfolio.
How much flexibility and agility do you have in a fund like this to revisit some of those themes? Of course, business cycles are over a large period. If I look at a real estate, upward business cycle, it would be over a decade. But if fundamentally things change, if there are policy directives which change, what is the agility that you have?
We expect this portfolio to be higher turnover and more agile, significantly more agile than our regular funds. We expect it to be bolder in terms of bets. In our, in our regular funds, say a mid cap fund or a flexi cap fund, sector overweights, underweights are benchmark plus minus 5%. Here we are very happy, as I said, to be up to 40% in a single sector, even if it has no presence in the benchmark. So that is extremely bold. We are also very happy to cut those weights very dynamically. So we're very happy to go from 40% in a single sector to 5% in a single sector, if that's what the data is telling us. So 2 points, a lot more boldness in bets and a lot more agility in decision making than regular funds, because the construct of that is business cycles. The intent is to do really dynamic sector rotation, and true to label is something that's very important to us.
And clearly it shows in the returns. So I was seeing the communication, and in the last 1 year you've seen about a 69% return. Now that would be an outlier, wouldn't it? Because the last couple of years have been exceptionally good. So for a communication to our viewers right now, what are the kind of returns they should look at, and what is the risk appetite you need for a fund of this nature?
So, firstly, we're not giving any forward-looking guidance. Of course, we can only, since it's a data-driven strategy, we can only provide back-tested communication, which is what we have done. And I never like to showcase 1 year returns beyond a point because 1 year is just 1 year. And what we think is when you look at rolling 5 year returns, the risk of the strategy is very similar to benchmark risk. And the rolling returns, we think we should be able to deliver 4-5% alpha to traditional benchmarks, like NSE 500. Again, I'm saying these are back-tested numbers, but that is what we think we should be able to deliver.
Okay, so that is fantastic. That's, you're playing it down, Radhika, but those are fantastic returns, and I know you can't give forward looking.
Yes.
But to the second part of my question, who is this for? Who is the investor who should be looking at this? Someone who's starting out, or someone who's now comfortable with their mutual fund investments and wants to venture further?
I think there are two use cases. One is it's a core portfolio allocation for anyone looking at a alpha solution in the large and mid cap space. And that, in my view, is a large number of people because large and mid cap is the core of someone's portfolio. The second is, as I said, for those who are looking for an alpha through sector rotation and buying a manufacturing fund today and a PSU fund today. For instance, the fund was very silent in its historical exposure to PSU banks, but started picking up PSU banks in 21, 22 when we saw momentum moving in those stocks. So for that category of investor who's looking to aggressively sector rotate, I think this is a great single point solution. It's also a far more tax efficient way rather than buying one sector fund, then second sector fund, then third sector fund, because here there's tax at the fund level and there's no individual tax on churn. So it becomes a lot more efficient. Is it a first time investor solution? I don't think so, unless you have risk appetite. The first time investor solution is large and mid cap index fund.
So it's not for everyone. All right, we have a very little time left, Radhika, but since I have you here and we are looking at a very interesting phase in the markets right now, budget coming up, etc., I can't let you go without a view on where we go next. Do you think we're in for a breather for the sort of bull run that we've been seeing, a phase of consolidation, or the next upcycle awaits?
As I said, I think the business of prediction is a very tricky one. I think the Indian economy is on very good stead. Finally, markets respond to corporate earnings growth, and
Right.
corporate earnings growth has been reasonably solid. So we remain very optimistic over 5 years. I think it is very hard to talk about the next 6 months. We have two major elections happening, in important countries in the world. One thing, though, I will say is that I've noted that corrections in Indian markets, because the domestic capital base, the SIP book has gotten larger, have become a little less sharp. So I think the market is starting to acquire a tad bit of a Teflon coating because of the kind of domestic capital base that we have. And that's something that we should be excited about. But I really always I emphasize the long term and the fact that this will be an incredible decade.
This is going to be an incredible decade, and of course, mutual funds is the best way to ride on to it. Thank you so much, Radhika Gupta. Always a pleasure speaking with you. And that's all the time we have today on the Mutual Fund Show. You were listening to Radhika Gupta of Edelweiss, and stay tuned for much more on the other side on NDTV Profit.